Hey guys, good morning. Grab your coffee. We're going to do some chart review. Going to look at the calendar this week, get our game plan in order, look at the rules foundations for how we're going to approach the market. Then we can look at Quick Strike. They've got a lot of new changes, some brand new features are coming in. It's really looking good. I'm going to share some things I'm doing with you on that. And then I'm going to look at some charts after I get the IV levels, the open interest and deltas using the Black-Scholes model. So once we look at the charts, I'm going to show you some quarterly, monthly, weekly, daily on the ES&Q and crude. So that's going to cover it. It's going to take a while. So like I said, get your cafe uh, and let's get to it. So first, let's look over here at the calendar for next week. And Monday is a holiday, but we got China reporting, and they have been in a world of pain lately. They've closed their economy down for quite a while, and um, you, we're seeing just a smidgen of that in the numbers that they report. This realistically, perhaps 10 times worse, I would guess. You know, at least 2 times or 3 times worse, maybe Six Sigma. I would guess. I mean, they've closed it down for a couple of years now, and they were welding people inside their buildings. So not good. Their numbers are shit, and they're trying to attract capital to come back in. So now they've made this victorious proclamation that our markets are now back open, come back, and I don't think people are falling in line that fast to invest back in a totalitarian um, psychotic regime or whatever you call it. So they weld their people in their buildings. I mean, there's no other way for me to look at it. So I'm, going to say that that's going to put that negative bent on Tuesday going into the PPI retail sales. We have Fed Speaks coming out, so they will shape the market the way that they want it to be shaped going into the report. Um, and what can we expect from this retail sales and PPI coming out? Industrial production numbers, FOMC again, talking, Red Book, um, you know, capacity utilization rates, more BLS, machinations. Thursday's real estate day and Philly Fed, and we do have jobless numbers, so that's going to be market moving. Friday, really nothing, existing home sales, and that's it. So the magic is going to be happening Wednesday and a little bit Thursday. We've also got earnings, and we've also got VIX expiration and OPEX. So it is a jam-packed week. I mean, for that reason. So OPEX on Friday could get, things chopped around a little bit as positions open and close. But for the most part, I'm going to focus on this PPI, and the producer prices are going to be what controls the market shift. And we already know that retail sales grew. Um, and the commentary states that the purchasers are holding up demand. I mean, they're buying into the high prices. And so that's favorable. And it just depends on how high those high prices were. So we need to go back to the calendar and look at the prior PPI prints and see what the trajectory for that is. And it came down a little bit in November. I want to show you this so we can get the historical prints right here. So actually, yeah, November it came down, but December Wait, November was up. October was down. September was up. August was flat. July was down. June was up big. So we've got to keep our eye on this level, but we can see it is graduating down. Now, this is the last month of the year, and so to get all the bad stuff out of the system, they may pop the PPI report higher. That's why Nancy Pelosi is selling all of her stocks, I saw on Twitter this morning, and everybody's getting out of the market. It has been broadcast far and wide that, they're selling equities and buying the Bitcoin this week. So that's the game plan. I'm just throwing a little warning out to everyone that if we get a miss on the, well, a beat on the PPI, meaning it's lower, so anything I would say under point 0.5 or lower would be very positive, supporting that retail sales. You know, we want an economy that can sustain itself. And it looks like if producer prices are flatlining or we're at the top of that inflation, which it looks like we have been coming down, then we're at peak inflation, peak rates, the economy holding its own. We could see a dip and rip next week. So just be careful, all I'm saying. Um, Futures are futures. So how do we play this? I like, the only thing I do really is a standard deviation on various time frames. And so if you pay attention to the bell curve, it's very simple. 68% of the time, you're going to be inside the ones. So if it goes out of the one, right, it goes to the two. Do you see the 95% goes to the two? And then if it goes out of the two, it goes to the three, 99.7. So most of the time, your world is going to be between the twos and the ones. Um, Very seldom does it get down to the threes and beyond, the tails, the extensions. And so if we know if we're going to be going outside the distribution on a particular time frame, like a weekly, daily, quarterly, 1 hour IB, the first hour of trading every 14 sessions has a 1, 2, 3. So the algos are triggered on that one. You're either in it or out, right? If you're out, you've got a chance to go to that higher time frame daily one, or the Globex one, or the weekly one. So you have to get through the 1 hour B one first, right? So there is a progression to these that you can key in on with algos and know whether you're inside the ones or outside. And if you're outside and it is a low volume day, like we've had historically low volume, um, then you want to trade RTM back to the middle, right? Low volume would stay inside the range. If you have high volume or volatility, I'm saying volume, I apologize, high volatility, then you want to be going for outside the range. So it can be easy to, get a game plan to just do that. Volatility, low volatility, where, the VIX is below 18 again, or, I don't look at the VIX, but we'll see on my chart. So low vol inside, high vol outside. It really doesn't need to be more difficult than that. And then we'll look at other um, methods like Black Scholes and Bollinger's or whatever. The statistics is what it's all about. This is what the banks use and the market makers and the hedge funds. So you have to understand this. Dr. Pisani contacted me and told me 2 or 3 years ago when I first started showing my PT indicator that he has never seen anybody be able to replicate what I've done. The author The manual of statistics told me that. Yep. So that was that was an insane nice thing. So here is the magic. Um, Showing you the volatility. I can measure it on a threshold of 100 to know that when you're getting outside 100, have it come back in, and show you that for a decade or more, the volatility was crushed by the Federal Reserve, and it was well below 100. In fact, it was well below 30 most of the time. So we lived in a decade of volatility below 35 and little tiny ranges. And it was very difficult um, to trade that. And you were able, though, to spot the outliers very easily and then get positioned at those locations to come back in, especially as you got the vol crush, right? Go back in. So once you understood what it was that you're working on, you get the rising vol. The vol starts flying. That's usually when the market starts selling off. Do you see that? So all we have to know is where are we in relation to the threshold? Is the vol being crushed again? Um, and where is the vol relative to that? I've got at least an easy to understand threshold. It's 100, right? So here was COVID came up over 200, and then the vol crushed back in and it goes back up. So here we have it going back inside, and we're at 63.75 on the daily, and we're floating up. We are just now hitting the JP Morgan call collar, right, at 40.30. So that has been holding price. That is their collar. And the way that they work is they have a call, they sell a call, so they don't want price to be above it, and they buy a put and they sell a put, right? And so this bottom put, you they do not want price at all going down below that. That would be disastrous for their portfolio. So we can already presume that's not ever going to happen. So we think that the floor is going to be around, 30.30, 30.40, if it even got down that low. But most of the time they're going to be defending this put at 3600, and that's where we'll see in the quick strike where all the heat is stacked, the open interest. And if my presumption is right, we're going to look at quick strike in a few minutes, that we have an opportunity with PPI being flat or low. Instead of the market crashing, we can actually go higher, right? And so where will it be going first? Well, 4150 is the high put or the high calls, and 4150 is just above uh, the quarterly ones. That's where the call wall is. Um, I do know that you know that's going to attract the market like a magnet, right? For any longs. And so when they work their way through this quarterly resistance, we have to think on the calendar, we're nowhere near the end of the quarter. So these levels um, won't really play. They're not really coming into effect. The market doesn't care that it goes over the quarterly one at this time because they're nowhere near the quarter end. With that said, you have to see what's going on with the other time frames. The monthly, you can see that we were sitting on all this resistance, and I was tweeting out a bunch of, monthly resistance, and you can see 1, 2, 3, 4, 5 days, 6 days. It was not able to get through my monthly ones. So the monthly ones have been holding, and it is, midway through the month. So we're still holding the monthly ones. The weekly ones for last week um, did not come into play because of the monthly ones, but there were the twos sitting there too, and we had a 4061 that um, is now going to be the new um, target for next week. 4061 for the upside. We need to get through these resistance bands between 4030 and 4039. Downside for support, 3975, 3950, 3919, and 3855, 3850. And there's also a white one down here. So if it does get started, it probably would go to this last white one, 3791.75. So I'm going to say on the weekly, um, 3791.90 and 4061. Now, you know, resistance and support are meant to be broken, and that's how the big, getting to the twos and threes do occur. And that occurs at the end of the month when we get these reports that come out, like the expiration and the OPEX and the earnings and all of that. So they do break and they do go to the two and three. So, but on, you know, first touch, the dealers usually put their risk lines on or near that support. I see the second standard deviation is just above it, or is that the third? The third. So, 4092, 75, 4100 definitely would be an outside target. And that's we can see the call walls at 4150, which is above the second standard deviation of the weekly open. So I can calculate these levels on the session open or the close. And this is a weekly or daily 7-day on the close. It's my mistake. So I can do, 7 days, 1 week, 4 weeks for a month, 30 days for a month, or I can do monthly. So there's many different ways to slice and dice these datas, and it's very interesting how the algos stay within these guidelines. Inside the ones is inside that 68%. They just sell premium and stay in there and, stay delta neutral. Um, see, I got up to the top one, came back in. Bottom one came back up of these various time frames. Here it went up to the top one, came back in. And here is an exercise. The distributions also for your daily, your time series, can be 3,000, 5,000, or 1,500. And the 1,500, 3,000 makes a difference in the way that the distribution prints. So you really want to be able to calculate both levels. So here is another example of putting the quarterly, weekly, and monthly together using 1,500 days, which is the closest that I would do for a quarterly. and you can see the top white line was catching support. Or excuse me, hello, resistance. I do that all the time. That is resistance, not support. And that is the 30-day 30-day close on the one. So there is a white line up here at 41.30, and I would, if you know we get that nice break, the 12-week close, so there's 12 weeks and a quarter. If we get that downside PPI showing that the prices that the manufacturers are having to pay are lower than expected, then we're going to get a rally. And as we see in Quick Strike in a few minutes, we're going to, there's nothing really stopping it. There's a call wall at 41.50 that will take nothing to go through. And I think that the level will be up here at 4,300, 43.40. Yep. 43.20 and 43.40. 43.40 is another call wall, and 43.20 is my last white line. And that 43.18, that is a monthly 3 on the open. So if it breaks the 1 on high vol, we can go long vol long. That's, where I'll be looking for price to go to as a target. On the downside, if the script plays out and everything is doom and gloom, we get the high PPI, the market's going to sell off. And no doubt it will be going back to the towards the range, bottom of the range quickly, as everyone is anticipating, right? Nancy Pelosi sold all of her stocks last week. So the upper end for the daily range is 40.66. So if it gets up there, you'll be at that outlier, and if you are a bear, you're going to be looking to see a bunch of bears coming in between 40.80, 40.66, something like that. So let's go to the I wanted to show you something. So I can time the volatility when it gets above 100. You can see that the longs start coming in. So when vol is high and it starts diminishing, that's when the price goes up. And when the vol is low and then starts going high, that's when price starts going down. So after low vol going up, and we have historically low vol, so any down up vol bar should be sold. Follow the vol, and it's that simple. So let's look at the quick strike. So I've got several quick strikes going. Did I shut them all down? I guess I did. Get it back up and running again. Okay. So now I've got two things to show you. First, I'd like to go through my normal traps of laying traps of going through the pricing sheets. First, seeing where the Black-Scholes model is for these levels. So the end of the month, I'm more interested in right now. This end of the January 31st contract, and that is in 16 days, right here, 16 days to expiration. So I'm going to change this to Black Scholes on the settlement, and I can see right here that 4020 is the mean of that contract. Yeah, it's more strikes so that we can see this. So I want to get my chart back up. Well, we'll just make a note. Monthly mean 4020, and the at the money is in the red around the mean, and the green is that you're in the money, so you start getting in the money for your options. And here the 1 2 is your first and second standard deviation line for the implied volatility. This is not real volatility. This is not my chart PT level. This is implied vol. So implied vol people do not have what we've just seen with the real volatility. So you can compare the IV with the real vol and have a total picture of the market. So the 1 2 standard deviation line is 4150, 4160, and so that is the reason that you see that all the calls are stacked at 4150. So when we come over here and look at a heat map for the contract, I think I had that up. We'll just put another one up. Make sure you're looking at the contract you want to see, end of the month. And there's the mean and the 4150. Here's your 10,000 calls sitting there. So that is the reason that the high calls are there, because you're at that 1 2 IV standard deviation. But we can show the 1 2 standard deviation on the monthly chart. I'm going to get that set up for you. 1 second. And I'm going to put the volatility threshold back on here also. So let's put this on the monthly, on the close. And I'll put another one, the monthly, on the open. And then I'll put a 30-day on the open, and a 30-day on the close. And we can do a 4-week, right? Because you can make 4 weeks into a month on the close, and 4 weeks on the open. Right? You understand that the session opens and closes at different times. So we can get our bell curve exactly right with historical volatility. Right there. And so we may not even make it up to that 4150. That 1-2 is way up here, and the real vol 1-2 is below it at 40.61. So if we see that turn, at 40.61, why would we expect to see a turn? Because in a bear market, they sell the ones, right? In a bull market, they're going to be buying the one. So see here, the volatility was coming down, down, down in August. Unusual. Usually August sells off, and the market went up. But when the volatility in September started rising, that's when the market went down. Here we flatlined volatility, flatline price, ranged up and down, and then it started falling down and price floated up to the one, right? You see the one? So they're selling the one. And here would be the third touch. Now, what can happen next week, and this is what I'm warning you about, is if you get a PPI that is flat or showing that the inflation is coming down at all, then this thing can rocket up because there's really nothing holding it except for that 41.50. And right now you see the volatility is coming down, down, down. So you're going to need to see that big, vol jump to go up to 100 or higher with price coming down. And there's much more room to go to the downside, isn't there? To go back to the mean or go to the bottom. 300 point opportunity to run it back inside the distribution, and they keep their spreads because that's the cheap risk, right? They sell that one, bring it back inside, then they're, holding the money in their pocket better. They sell premium. We're at the JP Morgan call wall. We're at the monthly one. So just for distributional purpose sake, if I were the Fed, I would give us a little bit of a, not too much, a little bit of a PPI beat, a 1 or something, maybe a .7 or something like that, not quite past 1, something close to 1, between a 7 and an 8, maybe a 9. 9 might be a little bit too hot, so, if I were, queuing the cue ball for a bank shot, I would be, and the bank shot being send it back down off the one back inside, I'd be looking at a 7 or an 8 PPI if I wanted it to come back down. Not too much to crash it, right? They don't, if they have their spreads and that they want to hold them, then they don't want to, make it too hot. So they could literally have the market go flat the way that they want it to be, mimicking their yield curve going into next year. We're going to start, seeing reduced volatility or volatility and inflation. So that is conducive to selling spreads for their premium and keeping it inside the ones. To get the most premium, you need volatility a little bit higher. So they pop the vol at the one to get it back inside and sell their premium and get the most bang for their buck selling premium. They get more premium on a higher vol. So, wait for vol to hit your one here or the 41.50 and come back in and sell it to get the maximum premium is what I'm trying to say. Spit it out. But we'll just have to see, if the trajectory goes back and hits 100 again on the volatility, or are they planning to crush the vol and get us back into 30-50 world like we were in? God forbid. I hope not. I really hope not. That was horrible. We like vol. We need some vol to trade with. Market needs to be a little bit normalized, and that's not normal. That's abnormal. That's, deliberate vol crush. So I wish everybody would get rid of the VIX, get Jats PT instead. Go to the website and pick it up, and you can see where we are in the volatility, the real vol world. I mean, Juan Sinclair, however you pronounce his name, sorry, Mr. Sinclair said that the missing component to the option world is real historical volatility. That's right here. You're looking at it. So this is the missing X right here. Okay, guys. So let's go back to Quick Strike real quick. I want to show you something else. In the Quick Strike toolbar, so say you get a trade idea, um, and you want to, be able to put some spreads together to see what premium you can collect using the Jats PT methodology. You can go up to your quick sheet at the top, tab up here at the top, and click that, and there will be an Excel-like spreadsheet available to you. Um, and these rows, you can use a formulated template, or you can create your own by selecting the columns that you would like to populate in your fields. And besides the column headings, for your Greeks or your premium, you can have column colored markers to separate um, the rows. So there's a way to customize your own sheet and or use a quick sheet that they've already put together for you. So if you click Learn by Example, that'll pop up many different ways for sheets that they've already put together. So if you like to trade outright calls or puts or spreads, call spread or a put spread, um, here, they have examples of what that would look like. So here's a 40-10 4000 put spread. Just click on it, and they've already got rows set up for you. Show you that you get, $580 in premium selling it, and you can monitor your Greeks and your position volatility changes, days to expiration, quantity, etc. So if you wanted to do a straddle or a strangle, so here's your strangle that I would, of course, change. That's your H3 strangle. You can come in here and modify your strike level either according to what you've researched for the implied volatility levels or the Jats PT levels. You can do that and get some ideas of how your strangle is working. And I think these condors, risk reversals, butterflies, all kinds of ratios, calendars, etc., etc., seagull, synthetic, um, custom. So here's some more like a collar. So a short put, a long put, and a short put. So you can customize some strategies. So definitely, get used to the lingo, how it's laid out, um, and it's easy to just be able to come inside your sheet once you understand it and just type in what you're looking for. The contract uh, expiration. Oops, type correctly. There we go. Get a trade idea and, you know, put something in. I mean, this is not a trade idea. That was just typing ridiculous stuff in there. But you can just learn to type your code in and it populates right away at your fingertips the information that you would like to extract from the platform. I think that's fabulous. And then if you don't know what spread you want, you can build one right here. So you could come in and say, use their uh, one, two, threes. Um, go to the end of their twos and threes right here, 4,500, 3,580 on the other side, and then invert it to make your short strangle. And this one, um, $1,114, 100 times the premium. So you could say, submit that. You've got another straddle idea, and if you'd like to go in and see now, or strangle idea, sorry, you could go in and see your smile. um, Look at your actual volatility by chart. Um, Look at your sheet. Look at the summary. See that the implied vol is supposed to be going up. Read about the implied vol, about the contract. Look for your open interest right here for the contract. See where it is, 4060, 3600. Recap, this is really nice. Tells you, information about the product. And here we can see that we're at the lowest implied volatility. Uh, the option trading centered around the January E3B 4150 calls and the January E3C 3330 puts. And the 4050 calls were the most active, and the high volume put was 3450 strike. And calls with the greatest open interest are the January EW3 100 strike. And the puts, the E3C at 3330. So 3330 seems to be the high downside. But here the implied volatility was moderately down as a 30-day at the money to finish 1 month low. So the IV on the 30-day was at a 1 month low. So that would signify that we're looking for that, volatility increase. Unless they just continue to flatten it out. I don't know what's going to happen. Trade the vol. So, but you can get this recap. It's excellent. And or look at your contract and get information about the specific um, trades and strikes inside the contract that you're looking for. And like I said, look at your volatility. Looks like a megaphone pattern indicating that shift in volatility could be coming. And I guess we're trading at 18, so we're at the low end of this cone. And we could go up to about 25, 26. So vol could rise going back up. Check your open interest. Seasonal DTE. spread analysis, um, and you can get your margin for the spread right here. I mean, damn cheap trade here. Well, maybe not. Pretty much. All right. So, you can, like I said, get a wealth of information by quick strike. Um, Futures also come in and look at futures curves and term structures and other tools. This is a CME, so you can see where the volume contracts are coming in. Um, there's so much you can do with this platform. So, well worth an afternoon just exploring it, and then build your own quick sheets. So I've got a few going. I do have my hypothetical spreads working. This 4,200 I'm a little bit nervous about. I might want to move that out to 43.40, 43.50 if we do get that upside surprise. But I think pretty much I should be in good shape with that 34.50 put by the end of the week. So that's in 2 weeks. The odds are that it's going to come back inside the distribution. We have more room to come back in, and 34.50 would give me plenty of room at this point. So if we turn back down, which makes more sense, everything considered, I would be looking, to hold my contract and collect my premium. And I think that's really what this is about going forward for me anyway. Get in a position where I can sell premium and then use that premium intraday for a day trading margin. So that's what I'll be working for. Get a funded account, and then apply these techniques. All right, guys, let me know if you have any questions, and if you um, care to ask me anything about Quick Strike, please do. But I'm just kind of new at it, figuring it out, and can say I like it a lot. All right, guys, we'll talk to you later.